Hey everybody, welcome back. We are on Unit 4, the financial sector. We're still focused on monetary policy. This is subunit 4.6. This is part 2. We're focusing simply on the tools of the Fed. Again, what is monetary policy? Monetary policy is the manipulation of the money supply to stabilize the economy. Manipulation of the money supply to stabilize the economy. What are the Fed's tools, to change the money supply? In general, they have 3 tools. They have 3 things that they control directly, that they set, And we're going to go through those in this video. Number 1, for sure, the big one, the one they do most often, the one that they use the most to do monetary policy is OMO. What does that stand for? Open market operations, In other words, open market purchases or sales of assets, And what assets are we talking about? U.S. Treasury bonds most of the time, So OMO, open market operations, that's their number 1 thing. In other words, they either buy bonds or sell bonds, and that is their way to put reserves into the banks or take reserves out of the banks, Now, I'm not sure if I, got that in the right order there, so let me make sure that we are clear, all right? If we are in a recession, what is the Fed going to do? So if we are in a recession, a recessionary gap, they are going to do open market purchases. OM purchases, They're going to purchase U.S. Treasury bonds. They're going to go, oftentimes the banks, they're going to buy U.S. Treasury bonds, they're going to buy U.S. Treasury bonds from those banks, putting reserves into the banks, in hopes that they can get the interest rate to go down in the banks and the banks to loan those reserves out, to increase the money supply. If we are in bust times, if we're in contractionary times, that is what they are going to do. If we are in an inflationary gap, if we have an inflationary gap, and that we associate with boom times, all right, they are going to do OM sales, all right, open market sales of these bonds, all right? So what does that mean? They're going to sell U.S. Treasury bonds in order to take reserves out of the banking system and hope that the interest rate goes up and there's less loans that are made, therefore curtailing spending, So again, open market sales of what? U.S. Treasury bonds. They're going to sell the bonds to pull reserves out of the banking system, hope that the interest rate goes up and to curb spending, There you go. That is by far number 1. So put a big star by it. The next tool they have for controlling the money supply is the required reserve ratio, They can set or determine the percent of reserves a bank must hold in regards to their demand deposits, So they can say, all right, banks, out of all your demand deposits, you are required to hold 10% in reserve, i.e. not loan out 10%. Or you are required to hold 20% in reserves, i.e. you can't loan out 20%. So, if we're in a recession, what would they do to the required reserve ratio? Again, in a recession, they want more spending. How are they going to stimulate more spending? They're going to try to get more lending, so they're going to actually lower the required reserve ratio. So, in a recessionary gap, they will lower the required reserve ratio. They'll say you can lend out a larger percent. You only have to hold on to, you're only required to hold on to, let's say 5%, some lower percent than what it was. If it was 10, they'd lower it to 5. If we're in booming times, they'd say, whoa, we need to curtail lending. We're going to make you hold on to more of your demand deposits, not be able to lend out as much of your reserves. And so, inflationary gap, again, that's what we associate with boom times. They would raise the required reserve ratio to curtail lending, borrowing and lending. Finally, the last one that they control directly, that they set, is this thing called the discount rate, The discount rate. It is associated with the discount window, all right? What is the discount window? That's the term we use for when the Fed makes loans to banks. What is the Fed lending to banks when they make a loan to a bank? Reserves. What is the interest rate they charge? It is the discount rate. So when they make a loan to a bank, the discount rate is the name of the interest rate that they charge banks. Again, the discount rate is the interest rate the Fed determines because it is the interest rate they charge banks to take out loans. So, what would they do if we're in a recession? They would make it easier for banks to take out loans for them so that they could go loan that money out themselves. And so what would they do to the discount rate? During a recessionary gap, they would lower it. They would lower it. During boom times, they would make it more difficult to borrow from them. So during inflationary gaps, they want to curtail borrowing. They would raise the discount rate. Okay, so my arrows here are in regards to the tools. My arrows here are in regards to the tools. Those are the 3 tools of the Fed for controlling the money supply. Hope that made sense to you. We'll see you in the next video.